Hey, it's Carl Lishing again. I'm an independent insurance agent based out of Lakewood, Ohio, and I've been doing this stuff for over 25 years, helping people with health, life, disability, long-term care, Medicare, everything about insuring humans, people, not the things we own like homes, boats, and RVs, but the complicated nature of insuring humans and their families. Today's topic is going to be a little bit about life insurance. It's something that's important. Um, some people recognize the need for it. Some people don't think they need it. But we all die. It's not a fun thing to think about, but it's going to happen. And then when that happens, there's final expenses that are left behind. Sometimes there's liabilities that need to be paid off, or family members that rely on us for income, and they might need money to live off of if we're not there to provide it. It can be used in business situations as well to pay off business loans, car loans, student loans. There's really a lot of reasons for owning life insurance, but it kind of boils down to the motivating factor if we should buy it or not. It's usually based on the fact that we love somebody or we owe somebody. And life insurance can be create financial resources to address those needs. Now, there's this old debate. What is best? Term life, whole life, universal life, term life, permanent life? Sometimes people say, don't waste your money on term life. You should only buy permanent. Other people say, no, buy term, invest the difference. In theory, it sounds good, but a lot of times the difference doesn't get invested. It gets spent on life, and then time goes by, their 20-year terms running up, and they still need life insurance. It's crazy how fast 20 years goes by, or 10 years. But we'll just talk about this a little bit more and kind of like the pros and cons to each side, because I don't think that one is necessarily better than the other, but they have different fits and different reasons we should buy them. So term insurance, which refer to that as temporary insurance. Yeah, we're going to call this temporary, temp for short, and perm, not for a hairdo, but for permanent insurance. So term insurance is going to fall into that temporary category. You buy it for a period of time, 10 years, 15 years, 20 years, 25, 30. Now, the longer the term is, the higher the premium is that the person's going to pay, because there's more probability that somebody's going to pass on in the 30-year window of time than a 10-year window of time. Now, term insurance, I think it's a good fit when people need to get to a higher face amount for a lower monthly premium because their budget is tight, and they need this thing to cover for a period of time when they've got certain needs that are going to be temporary in nature. Some of those temporary needs could be a mortgage. We like to think that maybe one day that house is going to be paid off, but sometimes it isn't. People move, they refinance their house, they take equity out of it because somebody wants a new kitchen. So maybe the mortgage doesn't go away as fast as we would like to think in a perfect world. Child rearing years, those can be temporary needs, hopefully, but sometimes that's not always the case. There might be families that are struggling with children that are never able to take care of themselves, or they never leave the nest. They just fail to thrive. But we hope to God that those child rearing years are temporary and our children grow up and become independent, successful adults. So that would be a temporary situation. With people with a special needs child, that could be a permanent, long-term situation. Debt, like credit cards, student loans, hopefully those are temporary in nature, and people might need extra resources that if they pass on early, that those creditors can be paid off. Because if they're not paid off, then they become creditors on the person's estate. And when they pass on, things need to work their way through probate. Personal assets, property needs to be liquidated, and the creditors get paid off first, and whatever's left can go to beneficiaries. So those would be some examples of temporary needs. If somebody is looking for something that's always going to be there, they should consider permanent life insurance. And on permanent life insurance, there's really, for the most part, two major kinds. There's whole life and universal. Now, universal life has some offshoots underneath it where it can be designed to do different things depending on the situation. Some of these can be cash accumulation products. So if the person dies early, there's a death benefit that pays out. But if they live long, there's extra financial resources that they can access in the future with tax-free income in retirement. Or they can be designed not really as much for cash accumulation focus, but more for like long-term death benefit, where somebody says, I want to guarantee that X amount of dollars is going to be enforced to, you name your age, you can take it out to 120. Now, to keep the premium down as much as possible, they might say, I want to pay it the whole time, but then they're going to have that bill to pay in their 70s or 80s or 90s and maybe beyond. Or you can say, I want to guarantee it to say 110, but I want to be done paying it by the time I'm 70 or 75. So I want to pay more now during my working years, but not have that bill later. So that can be death benefit focused universal life. Those are kind of like different spins. Now, in all of these situations, whole life, by the way, everything's pretty much fixed. The monthly premium is fixed. The death benefit is fixed. At certain times in the future, the cash values are going to be fixed. These days, I'd say with the people that I work with, a lot of times I'm doing whole life. For folks that are a little bit older, they lived through their 20-year term, and now they're in their 50s or 60s, and they still need life insurance. And the term expired, and it's getting more expensive to replace it because they're older. But they don't have the kids around anymore, but they're looking for something to leave behind for like final expenses. That one comes out of the bag a lot for that, or sometimes these guaranteed death benefit type of policies will work well in that situation. The cash accumulation kind, it's really how the policy is going to perform kind of depends on how much you put into it. Ideally, you want to start on those when you're younger, and then when you're in your 50s and your 60s, you'll thank yourself for doing it if you start early enough. If you don't start early enough and then you're playing catch up at a later date and time, you got to overfund it and put more into it to make these policies more attractive. Term life insurance, universal life, products have evolved quite a bit. They're not necessarily just for when people die anymore. Some of these products can have living benefits that if there's a terminal illness or a chronic health condition, they can advance a portion of the death benefit, which creates cash flow when they might need it to help with home health care expenses, covering health plan deductibles, time out of work. They have some attractive living benefits available these days as well. They cost a little bit more to have it, but it might be worth it depending on the person's circumstances. So the right fit or the right type kind of depends on the needs, but we should always not forget why we're getting it, and that's for the death benefit. So we should do a needs assessment to kind of take into consideration how much life insurance that person actually needs. A quick little way to figure out how much is appropriate is to take the word life, L-I-F-E, and turn it into an acronym. L-I-F-E. This accounts for a lot of the reasons people will invest in life insurance. L is to pay off those loans. Remember those people that we owe? I, that's income replacement. So if there's loved ones that we care about, to provide financial resources to take care of them financially, if we're not there physically to provide those financial resources. F would be final expenses. Living's not cheap, neither is dying. Funerals can get expensive, but then there could be other costs associated with final expenses like medical bills, or leaving cash funds behind to help fund an emergency fund. So there's a little bit of a cash cushion for the family to help take care of things if they need a new roof on the house, or the furnace goes, or a new car or something like that. And then E, that's education. So if people want to leave resources behind to help children or grandchildren with education costs, whether it's primary, secondary, or college, it depends on the person and what their choices are on education. So we do some little calculations on the husband or the wife or both to find out how much each person needs. And then we come up with the magic number. We talk a little bit about their budget and how much they can afford monthly, the pros and cons to the term versus the perm and which one's going to fit for them. And we start putting the pieces of the puzzle together. I call it reverse engineering the solution. Sometimes it's all term, sometimes it's all perm, sometimes it's a little bit of both. It just depends. But with the right approach, we can make sure that your family is taken care of and it fits your budget for today and tomorrow. If you'd like to talk more, please call or click on the link to schedule an appointment. Thanks for your time today. Bye for now.